the vacancy rate for offices in the US recently hit new highs in 2023 and now stand much higher than at the height of the global financial crisis. During the pandemic in 2020, the economy had to adapt to the new reality of lockdowns. This created a shift in behavior that we've never experienced before in human history: remote work. A trend that seems to have a lot of staying power even 2 years after the end of the COVID lockdowns. Now, this trend may be about to cause a major shock to the regional banking system. The regional banking ETF, KRE, is actually breaking down as we speak. But first, let's rewind back to March of 2023. The regional banking system was on the brink of a total collapse. Now, regional banks are defined as banks with less than $100 billion in assets. So when you take everything that banks own, including investment securities, loans, government bonds, stocks, all of those put together are worth less than $100 billion. And believe it or not, these regional banks actually own a lot of government Treasury bonds. Now, if you've been keeping up to date over the last couple of years on financial markets, you'll know that Treasury bonds have dropped significantly in value as a result of inflation and rising interest rates. And since regional banks own a lot of Treasury bonds, it led the regional banking system to suffer from around $700 billion in unrealized losses just over the last year. And this actually remains a problem today as Treasury bonds have continued to fall. But that wasn't the only thing that banks were suffering from back in March of 2023. Deposit flight was causing fears of a nationwide bank run. You see, when the Federal Reserve raised interest rates back in 2022 in order to fight inflation, it also led to a significant rise in the yield that you get from money market funds. But if you look at the yield that you got from savings account at banks, that stayed very low, which created a massive difference between the yield that you got for holding your cash at the bank versus the yield that you got from a money market fund, giving incentive for people to leave the lower yield and seek out a higher yield in money market funds, causing this phenomenon of deposit flight. And we can visualize that very well by looking at commercial bank deposits that have been moving lower throughout 2022 and 2023, while money market fund assets have been moving dramatically higher. Now, although that has slowed down throughout the rest of 2023, you can see banks haven't recovered their deposits yet, and money continues to flow into money market funds. Fortunately, the same Federal Reserve that caused the trouble in the banking sector by raising interest rates rapidly actually decided to step in and stop the panic by providing around $100 billion in liquidity to troubled banks in 2023. Of course, that helped ease any concerns that depositors had and slow down that phenomenon of deposit flight. And this actually triggered quite a steep rally in regional banks as all of these concerns around a bank run were eased. But fast forward to today, and we see that the regional banking sector, KRE, is breaking down once again. And if we look at the actual earnings of regional banks since the beginning of 2023, they've been moving down. So while the Federal Reserve reassured all of those concerns, it didn't alleviate the pressure that banks are actually under as a result of this high inflation and high interest rate environment. And in fact, they could be about to be under a lot more pressure. Because believe it or not, but regional banks also own the majority of commercial real estate loans. Now, commercial real estate includes all office spaces. the same offices that recently just hit a 19% vacancy rate. In fact, the number of delinquencies on these loans have been on a sharp rise since 2022. Now that means that businesses that took out loans to buy commercial real estate are not benefiting from their investment, and some of them are not even able to pay back the banks the money that they loaned out. You can see delinquencies on loans that are greater than $50 million are rising very sharply here. The worst part of this is that most of these loans come due in 2024, and a lot more of these loans continue to mature in 2025. So the number of delinquencies could continue to be trending higher heading into next year and potentially even the year after that. So while this may not trigger a full banking crisis to the likes of what we saw in 2008 with massive banks collapsing, remember this is the regional banking system, so relatively small banks, we can clearly see that banks remain under pressure from falling Treasury bonds, which are causing huge losses for the balance sheet of these banks, and the incentive for deposit flight that is still very much a reality today, with a record gap between the yield on savings accounts and the yield on money market funds. It will force banks to tighten their lending. When banks are in financial trouble, they reduce their exposure to risk by diminishing the number of loans that they give out. And as we can see from this chart, which is the quarterly loan growth of regional banks, the loan growth is expected to diminish quite significantly heading into the end of the year relative to the loan growth that we had in 2022. And in a credit-based economy, lower levels of lending translates into lower economic growth. It is moments like this where one needs to have a properly diversified and actively managed portfolio to avoid a steep drawdown in the stock market. Moves down in US stocks can be violent and very painful, and being properly diversified during them can allow you to compound your returns through these periods of volatility. That's why we are always looking to provide our clients with the best risk-reward macro trades that we currently see, especially in the current environment where it can be tempting to just go all in on an S&P 500 ETF.